Enterprise valuation faces two massive, unquantified risks right now, buried within energy infrastructure and pipeline architecture. We are tracking severe capital exposure splitting along two specific fault lines: localized grid instability and the rise of completely anonymous enterprise research cycles. Identifying the scale of these informational and physical deficits is the first step towards securing corporate balance sheets against the current market reality. The physical limits of regional power grids directly restrict the scalability of commercial machine learning and artificial intelligence. Data center electricity demand increases at 12% annually, outpacing global power growth fourfold. Below the curves lies a systemic timeline mismatch. Software scales globally in months, while physical utility interconnection requires multi-year construction cycles. Because of this bottleneck, 62% of major infrastructure operators will invest directly in dedicated, co-located renewable generation assets by 2027. Direct renewable self-generation provides a necessary bypass to secure baseload reliability where public utility infrastructure cannot meet deployment speeds. Concurrently, B2B energy procurement architecture has fractured, rendering conventional CRM tracking metrics inaccurate. In this pipeline model, the top 61% is hashed out, representing independent technical research completed anonymously before prospects contact sales. This unrecorded layer creates a capital imbalance. Vendors burn $9 on acquisition for every $1 invested in precision measurement infrastructure. Operating without automated AI multi-touch tracking to map this dark research phase creates massive informational deficits, leading directly to deflated conversion projections and depressed pipeline velocity. To protect operating margins, finance directors have to abandon short-term accounting metrics and reallocate capital based strictly on pipeline velocity and customer lifetime value. Converting these technical buyers during multi-year industrial cycles requires rigorous engineering-grade oversight. They reject generalized marketing in favor of strict, physics-informed empirical validation. This wireframe highlights a commercial installation where HVAC consumes 40% of total energy, requiring precise thermodynamic modeling. We reconcile these algorithms with regulatory codes using the AHCFT framework, a three-part loop routing automated decisions through adaptive feedback and an ethical bias layer. Integrating this infrastructure with digital twin architectures enables prognostic asset management, using computer vision to identify structural anomalies before any mechanical failure occurs. By generating the empirical documentation required for federal regulatory permits, these prognostic platforms satisfy the risk mandates of institutional lenders and decrease the firm's weighted average cost of capital. The non-negotiable enterprise directives are clear. Balance customer acquisition outlays with precise measurement infrastructure, deploy automated agentic B2B engines, and mandate direct renewable self-generation. Corporate capital must be actively engineered against physical grid constraints. Project 54.